Every morning, the United States government wakes up and needs money. Not a little money, trillions of dollars. And every morning, the same quiet machinery hums to life to provide it. You never see it. You never think about it. But the moment it slows down, the entire world feels it. So who actually pays for the US government? The answer most people give is wrong, or at least dangerously incomplete. They say taxpayers. They say the Federal Reserve. They say China. And each of those answers contains a sliver of truth wrapped around a much larger misunderstanding. Because the real story of how America finances itself is a story about a market so enormous, so fragile, and so deeply misunderstood that even seasoned investors get it wrong. Let us start with a number: $39 trillion. That is roughly the current size of the US national debt. If you stacked 39 trillion $1 bills, the pile would reach the moon and back more than 16,000 times. Now here is the uncomfortable question nobody asks in polite company. Someone owns that debt. Someone lent the United States government that money. And every single day, someone has to decide whether they want to keep lending more. That someone is not one person. It is not one country. It is a vast, distributed network of institutions, foreign governments, pension funds, insurance companies, money market funds, and central banks. They are all buying something called US Treasury securities. A Treasury security is simply a loan you make to the US government. You hand over your money today. In exchange, the government promises to pay you back later, with interest. These securities come in different flavors. Treasury bills mature in weeks or months. Treasury notes in 2 to 10 years. Treasury bonds in up to 30 years. Together, they form the backbone of global finance. Now ask yourself, why would anyone lend money to the US government? The cynical answer is that the US government has never defaulted on its debt, not once in over 2 centuries. The more interesting answer is that treasuries are not just investments. They are the closest thing the financial world has to a universal safe asset. When fear sweeps through global markets, investors do not run to gold first. They run to US treasuries. They are liquid. They're predictable. And because so much global trade and debt is denominated in dollars, almost every major institution on Earth needs to hold some amount of them just to function. This creates a strange loop. The more people trust treasuries, the more they buy them. The more they buy them, the lower the interest rate the US government has to pay. The lower the rate it pays, the cheaper it becomes to borrow more. And so the US government has, for decades, been able to run enormous deficits at relatively low cost. Because the world essentially decided that American debt is the closest thing to risk-free that exists. But here is where the story gets complicated. The holders of that $39 trillion are not who you think they are. Polls consistently show that most Americans believe China or Japan own the majority of US debt. They do not. Foreign countries combined hold roughly 25% of outstanding treasuries. That is significant, but it is not the dominant share. The largest single holder of US government debt is actually the US government itself. Specifically, programs like Social Security and Medicare park their surplus funds in special treasury securities, effectively lending money from one arm of the government to another. That accounts for roughly 20 to 22% of the total. The second largest holder is the Federal Reserve, and this is where most explanations go off the rails. When people say the Fed just prints money to fund the government, they are describing something real, but describing it badly. The Fed does not simply hand dollars to the Treasury. What it does is buy treasuries on the open market, injecting reserves into the banking system. This process is called quantitative easing. Between 2008 and 2022, the Fed's balance sheet swelled from under $1 trillion to nearly $9 trillion, much of it in Treasury securities. Economists like Ben Bernanke, who won the Nobel Prize in 2022 partly for his work on this very mechanism, have spent careers explaining that this is not the same as printing money in the traditional sense. But the practical effect, as researchers at the Bank for International Settlements documented in a series of working papers beginning in 2013, is that it does suppress long-term interest rates, making it cheaper for the government to borrow. So after the government itself and the Fed, who is left? This is where it gets genuinely fascinating. The remaining holders are a mosaic. Domestic commercial banks hold treasuries as high-quality liquid assets required by banking regulations. Pension funds and insurance companies hold them to match long-dated liabilities. Money market funds hold short-term treasury bills as the safest possible store of cash. And then there are the foreign official holders. Japan is the largest, holding around $1.1 trillion in US Treasuries. China is second at around $800 billion, a figure that has actually been declining for years as Beijing quietly diversifies. Beyond those two, the list includes the United Kingdom, Belgium, Luxembourg, the Cayman Islands, and dozens of others. Here is a detail that stops most people cold. When you see Belgium or Luxembourg listed as major holders, it does not mean those investors love American debt above all else. Those countries serve as booking centers for international asset managers and sovereign wealth funds that prefer not to be identified by name. The real money behind those entries could be from the Middle East, from Southeast Asia, from anywhere. The Treasury market is the financial world's most global and most anonymous market. Now ask the deeper question. Why does any of this matter to you? In 2023, the Congressional Budget Office published projections showing that within a decade, interest payments on the national debt are expected to surpass the entire U.S. defense budget. Not some niche economist's model, the official, nonpartisan scorekeeper of American fiscal policy. Interest is already the fastest growing line item in the federal budget. And it is growing because rates rose sharply between 2022 and 2024, after a decade near zero. Every time the government needs to refinance old debt at higher rates, the cost of just servicing what already exists climbs. This creates a pressure no politician likes to talk about openly, because the only ways to address it are painful. Raise taxes, cut spending, grow the economy fast enough to outrun the debt, or keep finding buyers willing to accept lower yields, which means depending even more on the kindness of the global investor community. And here is the twist that almost nobody sees coming. The assumption embedded in the entire system is that the demand for treasuries will always be there, that foreign central banks will keep buying, that domestic institutions will keep holding, that money market funds will keep rolling over treasury bills. But in March of 2020, and again in August of 2023, and again briefly in October of that same year, that assumption cracked. Treasury markets that are supposed to be the most liquid in the world seized up. Bid-ask spreads widened to levels not seen since the 2008 financial crisis. Researchers at the Federal Reserve Bank of New York, including a team led by Michael Fleming, one of the foremost scholars of Treasury market microstructure, documented the dysfunction in real time. What they found was disturbing. The plumbing that moves treasuries between buyers and sellers, a system that most people assume is as reliable as gravity, is surprisingly fragile under stress. Think about what that means. The safe asset that the world runs to in a crisis is itself capable of becoming illiquid during a crisis. The thing everyone holds because it is risk-free becomes hard to sell at the very moment you most need to sell it. This is not a theoretical concern. It happened, repeatedly. And it forced the Federal Reserve to intervene each time, flooding the market with liquidity to prevent a full breakdown. So the question of who finances the US government turns out to be the wrong question. Or rather, it is the beginning of the right question. The right question is, what happens when the system that has always provided the financing starts to show cracks? What happens when foreign central banks slow their purchases? What happens when domestic banks face capital constraints and can no longer absorb new issuance? What happens when the cost of servicing the debt crowds out everything else the government wants to do? Peter Bernstein, the financial historian, wrote in his landmark work that the history of finance is the history of confidence. Not gold, not growth, confidence. The Treasury market works because everyone believes it works. Foreign governments hold dollars because other foreign governments hold dollars. Banks hold treasuries because regulators say they are safe. Investors buy them in a crisis because everyone else does too. That circular confidence is not a flaw. It has made the US the center of global finance for 80 years. But circular confidence has a fragility that straight-line logic does not. The moment enough participants begin to question it, the dynamic can shift faster than any model predicts. Every morning, the US government needs money. Today, the machinery still hums, the buyers still show up, the auctions still clear. But underneath the calm surface of the most important financial market on Earth, something far stranger and more precarious is at work than a simple transaction between borrower and lender. It always was.